Good morning, this is Ted Long at Tortoise Capital with a review of the weekend trading report for September 10th, 2017. Market is in bullish normal conditions. It's overbought on an annual basis using NDX 260 in the middle of neutral at 68 out of 100 on NDX 10, so the short term is neutral. In the market mosaic, we're green bullish with price with respect to the 200-day moving average at 4.25%. Slope of the 50 is yellow bearish at 0.17. The risk index is the 30-period moving average of the VIX divided by the 10-period. 1.0 is the boundary between risk on and risk off. We're at 1.036 right now, so we were into risk on. This favors swing trades on the long side. That score of 1.036, looking back 5,000 trading days, computing average and standard deviation, lets us calculate the risk Z, which is at 0.31. This is a 90-day histogram of that indicator, showing we've climbed out of this volatility hole and have edged into the green. These are the current holdings in blended monthly rebalancing for September. Next reevaluation on or about 1 October. These are the winning positions based on closing prices on Friday. In ETF2, the theoretical exposure in the world market model is at 90%. In blended monthly rebalancing, looking at 13 and 32 ETF portfolios, you can see we have strength in Latin America, emerging markets, Australia. Only U.S. mid caps on a cash basis, cash position right now. Inside the ETF 32, same leaders. It's the internationals in South America, staples, energy, and agriculture on negative as well. Had some strength this week in gold and healthcare. In the ETF Max, here we go. In ETF Max, Brazil has started a very nice turnaround here. Being anything Brazil, looking very strong right now. Nickel, copper, Turkey giving back some of their gains. In the market health check, these vertical blue lines are 10, 20, 30 days worth of look back, 40, 50, and 60. You can see that the slope of the 10-period regression channel is up, with price hovering around the midpoint, right on the edge of the dragon, and finding support now at the Bollinger Band mean. Notice the river slope is flat for the last 10 days. 30-period regression channel sloping slightly downward, but as you can see by this sine wave looking indicator, that's the moving average of that 30-period regression channel. You can see it made a low here, and now is coming back towards the zero line. When it gets above that zero line, that generally I look at that as a favorable condition. You can see when it decayed, found support here, that was a positive thing. Jaws of PPO were still open to the upside, and line is above the signal line. That's favorable. And we're just coming out of some overbought briefly, but we have held support for 4 days above the 30-period Bollinger Band. So depending on, I think, reactions to the hurricane, and prayers for the folks in Florida, the market has put in really 30 days of failing to fail. It's resisted all of those attacks there, and 243.5 has held strong. So getting ready to make another run at this previous swing high. ETF 2 regional report, everything is on a buy signal with the exception of U.S. mid caps. That puts us at 90 and 10 on the allocation model. EFA at 62 is better than the S&P at 54, so it's still the globals doing better than the U.S. Inside the U.S., it's technology, then large caps, then small caps, then mid caps. Latin America and emerging markets are the two strongest sectors. U.S. small caps and mids are the two weakest. Inside the S&P sector spiders, weakness in energy, financials, staples, basic materials has made a nice comeback. Leading the way right now is healthcare at 64. World market model, it's the large caps dominating in the U.S., mids and smalls again lagging. Everything Europe is positive, as are Latin America, emerging markets, Western Hemisphere. Only Australia showing weakness here in Asia. ETF top 30 using the ETF2 lens. I place Alcoa in there just as a point of reference. See the strength that has come surging into metals. But China, Italy, Japan, emerging markets, all when they're green on strength and green on consistency, that's favorable. The ones that are green and white or green and yellow are recent emerging leaders, because they've been above average over the last 10 weeks, which is consistency, and then strength is the most recent relative strength measure. So green and white shows them starting to gain traction. These that are in white and then green are ones where they're starting to give back, and so that's looking like maybe some weakness creeping into Asia. Shifting to the daily report. Overreaction and channeling, no specific signals there. Lots to choose from in the auto framer, and among channeling and overreaction in the large caps, as well as some 5DDs. This washout pattern in DuPont we'll take a look at. That signal doesn't fire that often, and DuPont has been beaten up quite a bit, so we'll see if there's some potential deep value plays there. Real nice auto framer in United Technology. So here we have that 9-to-1 reward to risk ratio in UTX. This is a classic maximum pain range compression. You can see pretty easily that if it breaks below 109-ish, we definitely want to be short. But a price above about 110 would be certainly, I should say about 110.50. That would be long with a retest of this gap down at 115, and then Bollinger Band mean at 116 3/4, closing the gap 118. Top of the support level 119, all the way up to fair value at 122. I want you to notice that in this MACD histogram pinch, that this breakout here leads to a pretty good run to the downside, this rebound notwithstanding. You can see we have this would qualify as a Z3 pinch on another chart, and a Z3P channel, a reversal, and then a breakout here of that Z2. So back to our report. Let's take a quick look at Verizon at an RSI 2 value of 0. It's been horribly crushed. Maximum pain there on 10-day down, -5%. 4.2 to 1 on the auto framer, and it's a 5-day down. So let's take a look at that. This divergence from the RL270 got to a peak. Has now come all the way back to the 270, and this is about a 1, 2, 3, 4, 5, 6, 7, almost 8 days down. And so now support at 45.58 puts it right at the boundary, ready for a further collapse. And then if it collapses here, we wouldn't be surprised by a retest of about 43. And then on the upside, though, if it does find support here, suggested by that doji, it actually can find some support I would be looking for 48, 48.70, and then almost at 50. So a perfect location for a critical state. I really like that frame in either direction. Nike is also well postured here, sitting at a low risk entry in either direction. If this were to collapse below 52, you can see that we'll be testing another big move to the downside, but a rebound here gets it back up around 56 to fair value. You have a retest at 53.5, and then at 55. So again, critical state in Nike in either direction. The fact that this is getting ready, the MACD histogram has this slowing down, ready to cross over. Again, I would like to see it get above about 53.40, but we definitely have some room inside that one. If we shift down to the 30-minute charts, again, you can see the nice and orderly the sell-off in that 5DD has been, but then the support it's held at 52. So I look at that as it had an opportunity to fail all the way through here going into a long troublesome weekend, and it didn't. So this test at Z2, and you've seen some buying pressure here already. I don't see a technical reason why we wouldn't see a price test of 52.40, which would then take you up the step ladder to 52.80, 53, and then 53.28. So lots of interesting patterns to choose from here. Back to our scheduled report. All right, so let's shift over to the ETFs. Financials are in an overreaction, and they are a max pain and have a 2.4 to 1 auto framer. Let's take a look at that one. This looks interesting to me here. We have a support that leads all the way back to end of June. Support about 23.95 or 24. Higher lows. We had quite the move down, signaled by this breakdown when the RL10 crossed the Bollinger Band mean, and it departed here on the MACD histogram. I like this support around 24-ish, and I'd be looking at buying some momentum intraday. And again, this is the kind of move that you can see intraday in these sectors, a move from 23.87 to 24.18. That's 30 cent. That's a 1.5% powerful move, and no real risk of coming back to that previous close. So that looks like a step up. Found support around here around 24.10. Again, I'd be looking for this to be in a critical state. And then on the 10-minute chart, as we're getting ready to cross over above the dotted line, I would see any additional buying strength there as a real positive sign, and I would leap onto that. On the daily pinch and stretch, Home Depot, gold, healthcare, silver, all above the single day stretches above their Bollinger Band mean. Let's see what that looks like in Home Depot. You can see here on daily charts, Home Depot, we've been trading this a lot. It makes, not only has intraday tradability, but on a swing basis, this has a lot going for it. Notice the extreme stretch, and this move away from the close down to the Bollinger Band mean is why that's the number one stretch above its 30-day simple moving average. Its excursion from the middle of the river is how that is read. let's take a look at XLV as well. Again, XLV has made a nice stretch from here to here. And again, the crossover outside of the river and then the entry suggests right here is where it should have failed if this downward trend was going to continue, but it didn't. And so this re-entry into the river gives you the ability to enjoy that move. And now we are at an extreme stretch above. Let's take a look at some negative Z stretches. United Tech, I think we've already seen those two in terms of max pain range compressions. So let's just take a look at Disney at 6% down. And Disney, talking about max pain range compression once more, the fact that it didn't fail any further with a target around 103. And if it breaks out from there, closing the gap up here to 106. And then a retest of the swing high at 110, and then long-term fair value at 111. Any collapse below, however, should be exploited to the downside. We're going to take a look at most expanded pinch boxes next. These are the ones that the last 30 days have been so directional that the width of the river has gotten wide. And Nike, we've already looked at, and we haven't looked at Travelers yet. And so this is what happens. You get this really tight compressed move, and during this time, Travelers was on the least compressed list, and now out here it's on its most compressed list. And when you get that kind of a move, Friday, a mechanical entry above either the real body or the high of the day allows you to tap into these kinds of one-day moves, the reversal move, the reversion back to the long-term Bollinger Band mean. But that's, notice the width of that river. That's a 4 sigma width of the river. That tells you just how directional that move has been. So we're going to take a look at the Travelers move again. So once it broke above previous day's high, that's the kind of intraday move that you get as a response to a large move in the other direction. So this is what that extreme move to the downside that caused the river to be so wide on a daily basis. And then again, when you get this move above the previous swing high, bingo, around 115 to 119 in a single day's worth of move. Notice the signal here, as it, even if you waited till it crossed the zero line and got your entry up in here, when it had clearly crossed that. You're looking at a $4 move. That's a 4% move. So that, I hope this makes the case for why we care about these most expanded pinch boxes. These are the ones that, if the move continues in the same direction, it's easy to get on board the existing trend, but then you also get the possibility for sharp reversals in the other direction. All right, let's take a look at conversely. Now the ones that are setting up on the other end, where the river is very narrow. Let's look at Johnson & Johnson and Coca-Cola. River very narrowly pinched. You can even see that how tightly pinched it is down here. So now a breakdown below 130.45 allows you to continue this this play, but a rebound or a resumption of the move up. Even if you took a mechanical entry at 132.21, you get to play to the top of the river. But really, to me, the play to the downside is the one to be watching for. And then my estimate there is I look at the size of this move, the maximum excursion of the RL10 from the RL270. I come back to here and say, I hang that from the 270, say now a move down to 123 is not out of the ordinary. That would be that cannot be surprising, because that's the size of the moves it makes, and that would take it back to late May price levels. So you can make the argument to the downside why that's so powerful. But then if it does find support here at this double bottom, then you can hang from the bottom and estimate the upside being up above 140. That would have to clear this price level of the previous two swings, but you can see already from 131 to 135 is a tradable move intraday, and then you could build towards a swing position. Now, just notice in the last 30 days just how narrow this price range has been, and that's why it triggers on our pinched river compared to its previous river widths. That's an exceptionally tight pinch, and so breakouts from there are the ones that we really want to get on board, because the move can be large, like this last one when it went from 125 to 137, a 10% move. So let's look at Coca-Cola. Same thing, pinched river, voting to the upside, ready to go long at the instant we see any price gains north of 46.30. That's when you can buy comfortably. So now these daily super pinches, these are ones in which the z-score is less than -1. So these are all where the daily pinch box, in other words, the river is very narrow. You've already seen Coke and Johnson & Johnson. And then the regression lines, the 10, 30, 90, and 270 are all very tightly pinched. So let's just take a look at XLK as the one that is both pinched in terms of narrow river, and then all the price regression lines have been very, very tightly compressed. So everybody agrees what fair value is. Let's come back to the daily now so we can see all those regression lines. It has been pinched for a while, and you can see the 10, the 30, the 90, the 270. So everybody's in agreement that fair value is right in this tight little band. So breakdowns, any more breakdown below 58, and it comes down to 57 pretty quickly. Tests Z2 at 56, but really I think it would be a break of 57.5, and then the break of 57.25 would be decisive, and then this entire sideways chop gets challenged, and then it's back over here to 55.50. So there's lots of room for technology give back on the downside. Conversely, support at the generally rising Bollinger Band mean lets you get this kind of a move from 57.5 to 59, so about 3% on the upside. It closed weekly, so any early signs of strength allows you to get in both directions on a strong sector. Right, so auto framer and the RAF regression channels, we've seen these symbols already in various forms, so we know why they're interesting. Daily squeezes, these are one-day pops that are available. Let's take a look at MO. with a potentially nice one-day pop. Yes, indeed. The range compared to previous breakouts is small, so the range stat is large. A breakdown below 62, you've got to pile on that one. But then finding support down here around Z minus 1 gets you back up to about fair value around 65. And still, this may still be early in the rebound, but my expectation, we got to get back up to 66 is the short term. It gets above 66, and I think this has a real chance to react against this negative one-day price anomaly. Okay. So MO should be on our stalking list. Looking at the market mosaic, finding the slope of the 30 has gotten down around Z minus 2 and is rolling up. This gives me a longish bias. I think the market is not panicking at the sign of the hurricane, and I think that's already been priced in. So we've got some room to grow here. And that's everything I want to cover for this weekend with this last little bit. Again, a 30 Z-score rolled up. The 10 has pulled back to fair value. And the 90 shows the expectations slowing down, but well within norms. This is a market that can find support here and make this push. It's also one that if it breaks below about 240, then the downside is really the runaway play. So, many tactical opportunities and now some swing trades emerging for our use. This is Ken Long at Tortoise Capital. Keep your risk measured and your powder dry.